In today's video, I'm going to reveal a powerful chart that has helped my clients retire years earlier than they originally thought possible. After guiding hundreds of individuals towards a financially secure retirement, I've identified one major mistake that constantly holds people back. This mistake isn't about saving too little or choosing the wrong investments. It's about how they think about their money. Most people separate their savings from their investments, treating them like entirely different things. They assume that keeping a large portion of their wealth in cash means security and that investing is inherently risky. But what if I told you that that mindset is costing you years of financial freedom? Well, that's why I'm making this video today. And by the end, you're gonna have a clear understanding of how to maximize every growth opportunity available to you and how to implement it into your own retirement plan. Let's get right into it. When I speak with clients, one of the biggest questions they ask is, how can I retire sooner? But when most pre-retirees seek answers to this question, they often fall into what I call the safety wall. The safety wall is where people treat savings and investments as two separate buckets. They view savings as their own security, and they view investments as nothing but risk. And because of this, they allocate their wealth in a way that feels safe, but in reality causes long-term harm. This mindset has become the greatest obstacle preventing people from transitioning to the retirement they've worked decades to achieve. When people separate their savings from their investment and treat them as two completely different things, they assume that keeping a large portion of their wealth in cash means security, and that investing is inherently just a risky endeavor in and of itself. But this mindset is costing you years of financial freedom, and I have the data to prove it. Before we get into that, there are typically three major pitfalls of investment mindset that cause pre-retirees to delay their retirement for years longer than necessary. These misunderstandings are so deeply ingrained in our financial culture that most people never question them. Yet they're directly responsible for keeping thousands of potentially retirees working far longer than they need to. The first pitfall is focusing on short-term market movements. When stocks dip, fear takes over and people pull their money out of the market instead of staying the course. This creates a destructive cycle where investors sell at market lows, they lock in their losses, and then eventually they miss out on the recovery. For example, after the 2008 financial crisis, many investors who panicked and sold their holdings missed out on the 400% market growth that followed. People who focus on short-term market movements view investing as a point in time rather than a process that's through time. They see each market drop as a crisis rather than part of a long-term journey toward wealth accumulation. I've heard clients say some variation of the following multiple times in my career. If I lose money in the market, my retirement's at risk. Or if the market crashes, I'm gonna lose everything that I've worked hard for. These fears lead to irrational decision-making that can devastate retirement plans, precisely because they're acting on emotion rather than looking at the data. What these worried clients don't realize is that market timing attempts typically result in returns that are anywhere from 2 to 4% lower on an annual basis than just simply staying invested. This brings us to the second pitfall, underestimating the rate of inflation. Keeping too much in cash means losing purchasing power over time. Even if it seems safe, risk is something that can be described in many ways. There's the risk of running out of money. There's the risk of permanent loss of capital. And then there's the risk of losing purchasing power. Most pre-retirees focus exclusively on the first two while completely ignoring the third. Even at a modest 3% inflation rate, which is basically where inflation is now, the purchasing power of cash is cut in half every 24 years. This means that $100,000 kept in cash today will only buy $50,000 worth of the goods and services in your mid-retirement years. Imagine planning retirement where your ability to travel, maintain your home, or even afford basic healthcare gradually diminishes year after year after year. That's the real consequence of underestimating inflation. And the third and most damaging pitfall, equating volatility in the stock market with loss. Let me clearly define these terms so you can understand the critical difference. Volatility simply means the up and down movements in price that happen in the market. It's the natural rhythm of prices rising and falling over time. Loss, on the other hand, only occurs when you sell an investment for less than you paid for it, converting that temporary decline into a permanent reduction in wealth. Most pre-retirees mistakenly view these concepts as the same thing. They see a 20% market decline and believe they permanently lost 20% of their money, when in reality, they've only experienced a temporary change in the price of their investments. This misunderstanding causes them to make their biggest mistake, selling during downturns and converting what would have been a temporary volatility into a permanent loss of capital. In reality, volatility is merely the admission price for higher returns. Consider that since 1980, despite experiencing 3 major bear markets where the market falls at least 20%, including the 1987 Black Monday, the 2000 tech bubble, and the 2008 financial crisis, a well-diversified portfolio still delivered returns that more than tripled the value of safe investments like CDs or treasury bonds. By avoiding this natural market volatility, pre-retirees effectively choose guaranteed erosion of the purchasing power over temporary discomfort when the market sells off. This all leads to thinking that steady, low volatility returns are safer. But playing it too safe can mean years of unnecessary work before you can actually afford to retire. Most people have never actually run the numbers of what their current strategy will look like at any point in the future. And if they did, they'd realize they're on a slower, more uncertain path to retirement than they need to be. A conservative investor earning 3 to 4% annually will need to save nearly twice as much as someone earning 7 to 8% to achieve the same retirement outcome. Let's put it another way. On a $500,000 portfolio, the difference between a 3% and a 7% return over 15 years is nearly $500,000 in additional wealth, which would represent 5 to 10 years of unnecessary work caused by excessive caution in your investment policy. And although people do treat their retirement savings like a fragile piggy bank, it should be viewed as a powerful engine that drives strategic growth to accelerate overall financial independence in your retirement. The undeniable truth is this: market volatility isn't your enemy. It's your most powerful ally in your investments. Market sell-offs are opportunities to rebalance your account to your long-term target. It's not the time to change your overall allocation. As I often say, it's not timing of the market, it's simply time in the market. And panicking is not an investment strategy. This chart proves it definitively. Look at how the market has steadily climbed over decades, powering through every crash, correction, and crisis that occurs along the way. This chart shows the long-term return trends of the United States stock market. If you zoom out far enough, you can see that the overall trend of the market is from the lower left of the chart to the upper right. There are certainly some blips in the chart along the journey, but for the last 20 years, from January 2005 through January of 2025, your total return for investing in the S&P 500 was 10.6% per year. This return means that for every $10,000 that you invested in the S&P 500, it grew to $68,000 over that time frame. This chart solves the 4 consequences we just discussed. Instead of working longer than necessary, you harness the exponential power of compounding at 7 to 8% rather than settling for 2 to 3%. Potentially cutting years off your retirement timeline. Rather than losing purchasing power to inflation, your growth-focused portfolio maintains and increases your buying power throughout your retirement. Instead of letting fear control your future, you develop a strategic framework that turns market fluctuations into planned opportunities. When you stop seeing your investments as separate from your savings and recognize them as your savings transformed into their highest performing state, everything changes. Market fluctuations become the driving force behind long-term growth rather than something to fear. Volatility becomes the very mechanism that accelerates your path to financial independence. I'll walk you through the equity growth strategy I've used to help countless clients reallocate their nest egg from low to high growth so you can take some insights and possibly use it for yourself. Let's take a real-world case study of a client who is stuck in a low growth strategy. This particular client was 55 years of age, and here was their situation. They'd been saving for years, but they weren't seeing much growth. The current portfolio had about $1.5 million across both tax-deferred and taxable accounts. Here's what their portfolio looked like. It was in a retirement target date fund. 60% of that fund was in cash and low-yielding investments, and 40% was in stocks. They were worried about market crashes and losing what they'd worked for. They viewed the retirement date as the date they'd simply stop investing and then begin consuming what they had saved. They didn't view their investment time horizon as their entire life and the entire life of their spouse. They viewed it just as their own life. Here's how we transformed their plan. The first thing we did is we designated an emergency fund with 6 months worth of expenses. This was put into a high yield cash account. The one that we're currently using is Altruist Cash, which yields about 4%, but here's the real thing that I like about this particular account. It carries $1 million in FDIC insurance, which is much more than the current banks are. Number 2, we immediately rebalanced half of their account into stocks. The stocks consisted of both dividend-paying and income-producing stocks, but also included larger growth stocks to drive long-term portfolio growth. The third thing we did We created a dollar cost averaging plan with a goal of being fully invested in 8 to 10 months of time. Rather than putting everything in the market immediately, this client was particularly risk averse. So we decided to invest fully over time and take advantage of any market sell-offs that happen to occur and get more aggressive in our buying. The fourth thing we did is we showed them the historical market data so that they could build confidence in the plan that we were putting forward. We explained how staying invested through market downturns led to long-term retirement success. We reframed their perspective on volatility. We taught them to see that market drops were actually buying opportunities, not times to sell within their portfolio. The result? Well, their portfolio's growth trajectory completely changed. They went from having a cash-centric allocation in their portfolio to an equity-centric allocation that both provided income but also drove long-term capital growth to support future income. They gained confidence in their financial future, but the ultimate result was they were able to retire earlier than they had expected. This is the power of letting your money work for you instead of sitting idle in low-yield cash investments. Now, you should have a clear understanding of how this chart can significantly boost your savings growth without exposing you to excessive risk. However, it's important to remember that investment allocation is not a one-size-fits-all solution. There are several personal factors to consider before making major adjustments. Otherwise, you could unintentionally be putting yourself at risk. To ensure your strategy is the right fit for your situation, click the link in the description below and fill out the questionnaire I've put together. Once you've completed it, I'll send you a personalized video with actionable steps that will help you retire on time. And with that, I'll see you on the next one.